Let's get back in time 400 years ago. It is the 1600s. The Dutch East India Company, known as the VOC, become one of the most powerful and successful trading companies in the world. This company got established in 1602, and it was granted a monopoly on the Dutch trade in Asia by the Dutch government itself, meaning that no other Dutch entity could compete with it in that region. And this monopoly gave the VOC control over lucrative trade routes and resources and markets as well, enabling it to amass wealth and influence in its time and solidifying its position as a major player in the global trade during the 17th and the 18th centuries. The VOC was big and their trading operations were vast and complex. They dealt in a variety of valuable goods that were in a high demand in Europe. They sent out hundreds of ships on long and dangerous voyages to acquire these goods from places like China, Indonesia, and Japan, and so forth and so on from these places. Now, here's the thing. Running such a large-scale operation requires substantial financial resources, isn't it? Ships needed to be built, ships needed to be maintained, ships needed to be equipped for long journeys, crews had to be hired. And to fund these expensive ventures, the VOC turned to a novel method of raising capital, which is seeking investments from private citizens. This was a groundbreaking approach at that time. The company allowed individuals to buy shares, which is essentially pieces of ownership in the company, and in return, these investors would receive a portion of profits from the company's trading activities. This practice of selling shares to the public to raise funds was a revolutionary at that time and marked the birth of the modern corporation. By allowing private citizens to invest in the company, the VOC could gather substantial amounts of money without shouldering all the financial risk, which means that they did a very, very good risk management. Now investors shared both risks and rewards of the voyages. If a voyage was successful and profitable, the investors would receive a significant return on their investment. And conversely, if a voyage failed, the investors would share in the losses as well. The early beginnings of the Dutch East India Company are rooted in the late 16th and early 17th centuries, during a period of intense competition for trade dominance in Asia. The late 1500s saw European powers like Portugal, Spain, and later England establishing trade routes into Asia, mainly for spices and silk and other goods as well. Now, prior to the VOC's formation, various Dutch companies were individually sending expeditions to the East Indies, and these efforts were often uncoordinated and led to intense rivalry and efficiencies as well. So the States General of Netherlands recognized the need for a unified strategy. The Dutch government supported the merger of these individual companies to create a more powerful and competitive entity out there. So the VOC was officially established in 1602 through a charter granted by the States General. The charter granted the VOC a 21-year monopoly on Dutch trade in that region. The VOC quickly set up trading posts and bases in strategic locations like Java and later the key trading hub Jakarta, and their ability to monopolize the spice trade and their innovative financial practices laid the foundation for the dominance in that region. The VOC's success spurred the development of Amsterdam as a major financial center and helped the Dutch prosperity and achievement during the Dutch Golden Age. These early years of the VOC were marked by aggressive expansion, strategic alliances, and military engagement to secure their trading interest, and their model of a joint stock company paved the way for modern corporations, and their success had a profound impact of the global trade that we are living in now. In 1602, the Amsterdam Stock Exchange was established by the Dutch East India Company, making it the world's first official stock exchange. The creation of the stock exchange was a response to the need for a formalized marketplace where investors could come and buy and sell shares of the Dutch East India Company, which was one of the world's first multinational corporations at that time. Now, before the establishment of the Amsterdam Stock Exchange, the trading of shares and securities occurred in various informal settings such as coffee places or marketplaces, and the lack of decentralized and regulated exchange meant that trading was often insufficient and prone to fraud. So the Amsterdam Stock Exchange provided a structured platform where investors could come together to trade securities in transparent and regulated manner. Now, this formalization of the stock market helped to increase investors' confidence and liquidity, as well as facilitating capital formation for businesses so businesses can grow much more faster. The exchange introduced centralized rules and regulations governing the issuance and the trading of securities, as well as mechanism for price discovery and settlement of trades. And this created a level playing field for investors and helped to prevent manipulation and fraud. The establishment of the stock market had a big implications of the global trade and the development of the modern capitalism system that we are living in now. It allowed companies to raise large amounts of capital from a wide pool of investors, fueling the expansion of trade and commerce. The VOC success demonstrated the effectiveness of this model, leading to the establishment of similar companies and stock exchanges across Europe and eventually the entire world. Perhaps the most significant disruption caused by the VOC was its role in shaping the modern capitalist system. The company's innovative business practices and pursuit of profits at all costs laid the groundwork for rise of the modern capitalism and the development of the global financial markets. The Amsterdam Stock Exchange really played a crucial role in the development of the modern financial markets, serving as a model for the subsequent stock exchanges established around the world. Its establishment marked the beginning of a new era in finance, where capital could be effectively allocated to productive ventures through the buying and selling of securities. Cities such as London and New York established their own exchanges, drawing heavily on the practice and the principles of the Amsterdam Stock Exchange. In the 17th and 18th centuries, the Dutch East India Company, the largest transnational corporation of its time, conducted extensive colonial trade in Asia and establishing a vast trading network. At its peak, the VOC employed over 30,000 individuals and transported 1 million people from Europe to Asia over 2 centuries. Their merchant fleet operated throughout Asia, from the Red Sea all the way to Japan, maintaining a dominant position in trade competition with the British East India Company, which is known as EIC. Now, despite its early success, the VOC experienced its rapid decline in the late 18th century. And here are some reasons, but we're not going to go into the details of these reasons. You can go ahead and search online for the details. Reason number 1, the disadvantages of a monopoly business model itself. Reason number 2, high salary cost. Reason number 3, the lazy and corrupt employees. Reason number 4, unable to cope with the transformation of trade in the 18th century. Reason number 5, poor finances and the death blow by the Fourth Anglo-Dutch War.